On a hideous day, you know what's escaped the gravitational pull of the market? Restaurant Brands International, the quick-serve giant that owns Burger King, Popeyes, Tim Hortons, and Firehouse Subs. This morning, the company reported a fantastic quarter, finishing the day up nearly 3%. Real bad tape. That said, it's still down almost 3% for the year. Can it keep climbing? Let's take a close look with Patrick Doyle. He's the turnaround artist, executive chairman of Restaurant Brands International. Find out more. Mr. Doyle, welcome back to Mad Money.
Thanks, Jim. Appreciate it.
So, Patrick, you said when you were on last time, look, we're going to remodel stores, we're going to put more money in advertising, and most importantly, you said we're going to reduce customer complaints. You wanted customers to like the places more. Give me on the checklist, how are you doing?
Yeah, we're making good progress, Jim. I mean, the quarter was terrific. We made great progress on a number of fronts. But most importantly, as you said, we've got to be more consistent about execution. So we've got to have better looking stores. We've got to execute in the stores, making great food every time, speed of service. I have to call out Tim's. I mean, they just did an exceptional job. Their speed of service came down yet again. They're getting even faster. They're executing at a high level. They're really the roadmap for what we have to do everywhere, which is great food, served at a good value, give consumers choices kind of up and down the menu, launch some interesting new things, and always do it at a high level of execution. And I think really what you saw this quarter was the brands all doing a pretty good job on that.
Let's talk about Hortons. What in particular, day parts, cold brew, what is really kicking butt there?
Yeah, it was both. This quarter was both morning breakfast as well as PM food. They've done just an exceptional job. So it was really pretty balanced. I think in Canada, we were up about 7.5% on the comp. I think 6.9 blended with the US. And that was really equal amounts, both AM and PM. So interesting new things in the afternoon, cold beverages. In the morning, we just continue to be a power up there. We're doing over 70% of the coffee sold in Canada. And with the frequency we've got up there, it's very easy for us to convert those customers that we're getting in the morning into coming back and trying us in the afternoon.
Well, how about the share take you must be taking from the pathetic Starbucks that I saw this evening?
We are definitely taking some share. In fact, I think we took share really across all of our brands this quarter, except maybe Firehouse.
Right.
But Popeyes, Burger King, and Tim's, I think, all took share.
I don't want to be too hard on Starbucks. They're obviously having a very tough time right now, and you guys are a beneficiary of it. They've become a share donor to others. Maybe they can right the ship. Maybe they can't. Let's talk about Popeyes. I see you got a new manager. You're expanding that brand, which I think actually works better overseas. I used to see that when it was an independent company. I was always surprised. Whatever country they went into, it worked. So obviously you've got some grand plans there, too.
Yeah, we sure do. I think we're close to 1,200 restaurants now outside the U.S. I think our comp was mid-teens for Popeyes and international. I mean, it is just booming. It is working most everywhere. Certainly we'll be going to new markets. It takes a little bit of time to work it out, though. We launched in New Zealand yesterday, and we had just a phenomenal opening. So we are very excited about Popeyes and what it can do around the world, as well as in the U.S. I mean, we're growing at a very fast clip in the U.S., both on comps as well as opening new stores.
All right, now, obviously, we've got to talk about Burger King, $11.5 billion in sales. Look, still good comps. I don't want to get down on it because the competitor Burger King is not doing as well in terms of comps as Burger King. But obviously, you're still not happy with how it should be doing.
Yeah, I mean, look, the consumer, as everybody has talked about, the consumer is a little tougher. So things were a little bit more muted, but we felt good. We took share this quarter. It's performing at a high level. And I think the most important thing is all the investments that we've talked about that we're going to be making into this brand, most of that is still on the come. So you've seen elevated levels of advertising, but that's going to continue. You've seen us getting some of the equipment in the kitchens into a better place. That is going to continue, obviously, to be there and operate with the new equipment. But in terms of the re-images, which is where a lot of that capital is going to go in, that we know is driving good results. When we re-image the restaurants, we're getting kind of a mid-teens sort of a lift. Most of that is still coming. And we're still under half of the restaurants being our modern image. And over the course of the next 4.5 years, what we announced this morning is we're going to get that to 85 or 90%. And so half of our restaurants coming through getting re-imaged, if we can maintain a double-digit lift on those restaurants as we do it, and we think we're going to be able to do that, that's going to drive terrific results over the next
that'd be
few
huge.
years.
But Pat, let me ask you, you mentioned something, a lot of our viewers are well off, I admit that. There's nothing the matter with doing well in this country. But they're going to hear, well, times are getting tough. And I think that a lot of people don't understand that on a percentage basis, burgers have moved up in price. Now, it's not like people going to Le Bernardin and saying, wait, I got to hold back on the Cristal champagne. But I think there are people at home, for many of our viewers, may not understand why there is some sensitivity to burger prices. And you can't double the price of a burger.
No, you sure can't. You sure can't. And look, to me, you've heard me say this many times. The most important thing for traffic in the QSR category is employment. And employment is still pretty darn healthy out there. What you've seen over the course of the last, couple of years is brands had to take a lot of price. Some did it smarter, some didn't do it quite as well. We think we've got a great menu offering now that has higher end items and kind of entry-level items. So wherever the customer wants to come in and do business with us, we've got a great offering for them. We saw that. We were basically flat on traffic, which was better than the category in the first quarter. But they certainly felt the price increases of the last couple of years. So I think that muted things a bit. But as long as we're executing and we're pulling lots of other levers than just doing something crazy from a value perspective, we think we've got an offering that's going to kind of meet the customer for whatever they want to buy and whatever they've got to spend. And as long as they're employed, they should keep coming. We've just got to have something that they're going to look at and say, that's good value for what I want for this meal today.
Well, I want to salute you. You've delivered on everything, as I knew you would, and it's just obviously still work in progress as you get those Burger Kings looking nicer, put some more Popeyes up around the world, and Tim Hortons, what can I say? Operating, hitting on all cylinders, but I know that's probably still not enough for you. Patrick Doyle, Executive Chairman of Restaurant Brands International, and a true turnaround artist situation. Patrick, I love you being on the show. Thank you.
Thanks, Jim. Appreciate it.
Everybody's back after the break.
Coming up, can this financial stock sustain a recent rally? Take the express ride to Cramer. Next.